Markets have been moving a lot this year, as we've talked about in our recent updates. As a quick recap, the March quarter resulted in one of the fastest share market falls in history. Falls of this size are typically referred to as a bear market. The direction reversed in the June quarter, with markets recovering at an extraordinary pace. There was a real stellar move in the US where the S&P 500 index posted its largest 50-day advance ever, and closer to home, the NZX 50 was down just 5% from its all-time high by 30 June. So far I've focused on the share market results, but let's look at our outlook for the real global economy. There are a lot of views as to what will happen next, and terms like a V or a W are being used as a shorthand way to describe the potential recovery. Let's look at what a few of these might look like. The V suggests a faster recovery from a deep recession. That's the dark grey area. And the W suggests a second or several drops might happen. The U and L on the right suggest a protracted, slow recovery. Some people are referring to the swoosh recovery. That's a shape like the Nike logo, which suggests that after the recession, a long, large recovery could follow. The recent stock market returns do give the impression that a V or a swoosh-shaped global recovery is on its way, but the next months may not follow this pattern. The reasons to be less optimistic really all stem from the high degree of uncertainty the world still faces. The biggest unknown is whether the second wave of infections seen in the US, parts of Europe, and then closer to home in Australia can be controlled without great economic damage, but also if or when a vaccine becomes available. These mean there remains a risk that a W or an L could materialise if governments have not provided enough stimulus or there are further lockdowns as Auckland has experienced in August. Around the world, governments have been supporting their economies with initiatives designed to keep companies afloat and put money in the pockets of affected employees. The New Zealand Wage Subsidy Scheme is a great example of such an initiative, and the scheme and its extension has supported 340,000 jobs. This chart from the Reserve Bank of Australia shows the COVID-19 additional spending by country and shows two key messages. Firstly, each of the colours shows how much of the total spend was allocated to a particular activity. The dark blue bars depict wage subsidies and clearly show that the New Zealand Wage Subsidy Scheme was a larger part of the New Zealand spending response than it was for most other countries. Secondly, the total size of each bar is shown as a percent of GDP, which is a common measure of the size of the economy. Generally, the bigger the response, the more aggressive the government has acted to support its economy. Alongside the fiscal spend, reserve banks around the world have kept the cost to borrow low and markets liquid, and they're doing this by keeping interest rates low and buying bonds. Overall, we think the government stimulus has played a lead role so far by limiting how bad the shutdown could have been, but has also been a key factor in driving investment returns. Despite the severe stress experienced in March, the returns achieved to June 2020 were attractive for members. All of our investment funds achieved a positive one-year return and have achieved attractive long-term returns. We continue to have strong conviction that retirement wealth is most efficiently built through an investment in a diversified portfolio of growth assets held for a long period of time. So unless you've experienced a significant hardship, the best course of action is likely to be staying invested. Even if your personal situation hasn't changed, it's a good idea to review your investment goals regularly. Our online risk profiler can help you understand your strategy and attitude to risk, and this can help you determine which fund is right for you. You can find this really useful tool on our website at aonkiwisaver.co.nz.